In this video, we will talk about Applied Materials. This is a stock that I have been following for many years now, and I think that's a pretty good deal at the moment. So if you are looking for stocks to buy, this may be a good opportunity for you. The name is Applied Materials. They are operating in the semiconductor industry. And if you look at the margins, they are fine. If you look at the growth rates, look at this at the left in blue, you have the revenue up and to the right, net income up and to the right here. They don't have a debt problem. They have a good balance sheet. They produce some strong free cash flow. You look at this, the free cash flow growth is up and to the right. They have very a good efficiency. You have a return on invested capital ROIC here of 30% basically, and the capital allocation strategy for the business is really simple. They do buybacks. They have a buyback program. So basically you have an efficient business model that is growing, that is doing buybacks. They don't have a debt problem, and they give you also a small dividend yield of 1%. All of this beautiful package for a PE ratio of 18 and a forward PE ratio of 14, 15. If you look at the stock price, it has dropped significantly. This is a semiconductor company, so obviously it's cyclical, and this is not the first time it happens. Also, you see here in 2022, it fell for the same reason, for the whole industry dropping at the same time, and it rebounded sharply because the business is well positioned in this growing industry. So they will have a secular tailwind because the semiconductor industry is poised to grow in the future. And you see here you have some cyclicality. And every time you had a cyclicality and the stock went down, it was a beautiful moment to buy. So maybe this time is different, maybe this time is special, but I don't believe so. I believe this is a good business, and I have in my portfolio another similar company, but maybe I will have to buy this one too because they are extremely good deals at the moment. So for the remaining part of this video, I want to react to this video from Stephen McNamara, and you will have a complete overview of what is this business, what do they do, are they efficient or not? What's the strategy? Do you have to buy or not? What's the target price, etc. I'm recording this video. We are April 11th, and this video is from March 4th. So maybe it will be a little bit late, dated. The prices will not fit, but as always, do your own due diligence. This is not financial advice. You can compare this with the current stock price of $140 at the moment. Okay, before we start, let me introduce myself. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, including great stocks like this. I just buy great stocks when they are in a temporary drawdown like this. So I've had a good performance so far, and the goal with this YouTube channel is to talk about stocks. We do stock pickings in this YouTube channel. So if you like stock picking analysis, we don't talk much about macro. If you like stock picking ideas, welcome to this YouTube channel. You can do whatever you want with the channel. You have plenty of videos, one every day. So okay, I hope the sound is great for the video. The video is 18 minutes long, so I will add some comments here and there. I will pause the video and add some commentary. And yeah, I hope you enjoyed the video, guys. Let me put the captions on.
Hello everyone, and welcome to the Mac.
That's it.
Today I'm covering Applied Materials, trading symbol AMAT. This company is one of the largest providers of semiconductor manufacturing equipment in the world. Recently, their share price has dropped about 40% from their highs, and I'm going to outline why I think investors should consider taking a position in this company. But first, a quick disclaimer. The information presented in this document is for informational purposes only. It's to support your due diligence and your research. This is not investment or financial advice. Please consult with a professional advisor before making any investment decisions. And with that, let's dive in.
Okay.
Applied Materials, trading symbol AMAT, is a global leader in semiconductor equipment. They supply the tools for chip manufacturing. When you read about companies like NVIDIA, they design chips. Then they contract the manufacturing of those chips out to contract manufacturers such as Taiwan Semi or TSMC. You may have read about them in the news. TSMC uses Applied Materials equipment to make the chips. This is a highly technical and complex engineering process. Usually, this means that Applied is embedded with chip production lines at the earliest consultation phases when a new production line is even being considered, as the design and production flow needs to be so precise. Simply put, chip manufacturing is a hard business, and there are very high technical barriers to entry, and Applied Materials is among the largest and most diversified companies in this space.
Yeah, what you will find, and maybe this video will talk about this, is that in this industry of semiconductors, you have a few key players. If you want some names, if you want some ideas, you have Lime Research. This is the company I have in my portfolio. Okay, very well. Same thing, some drawdown, and I think it's a good buying opportunity. You have AMAT, Applied Material, obviously. You have KLA Corp, here we go. Same thing, stock price is dropping, temporary drawdown, same efficiency. You have Tokyo Electron, I think. Yeah, this one, same thing. The charts are very similar. And you have ASML. So in this industry, the more time passes, the wider the moat. As time passes, regulation increases, the technical development is even more complex, and all this research and development infrastructure, this high investment costs, create a wider moat. So as time passes, as these companies are getting bigger, it's very difficult for a startup company from the Silicon Valley to come and disrupt this industry. So all these companies are in a better shape now than they were 10 years ago because of the inertia of this whole industry. So I think they have a clear moat based on all the means, all the infrastructure, all the digital infrastructure that they've built over the years. And as you see, the margins are pretty good. So you have companies with a moat, high margins, available at a PE ratio of 15. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
In fact, by some estimates, they have around 40% of the total global installed base of production equipment by tool count. This is an American company headquartered in Santa Clara, California, with a market capitalization of $137 billion. In the most recent quarter,
I mean, if you look at the latest data, the market cap is $120 billion. $110 billion, okay.
They did $7.2 billion in sales. They have gross margins of 49% and operating margins over 30%. Now pause and think about that for a second. This is a B2B manufacturing business. They do industrial tools, equipment, and services, and their operating margins are over 30%. When you can operate a business like this, it means you've got pricing power. And that pricing power is based on enormous technological barriers to entry.
Exactly. And if you had invested in this company 10 years ago, you would have had a performance of 21% per year for 10 years. That's it. And now you have an opportunity to join the train.
The things they make are hard to replicate, and they're very good at what they do. This is supported by their share price performance over the years. In the last 10 years, their share price has compounded on average at roughly 21% per year. And that's even after a 40% drop in recent months.
Yeah.
For value investors, if you can find a company like this at a good price, it's worth a look. And there's some reason to think that this company will continue to perform over the long term.
So a couple of months ago, the company was at all-time highs, maybe in, what was the timeline? Summer 2024. So I suspect you had a CAGR, a performance of not 21%, but you had like 25%, which is enormous, this is my objective, so definitely this is a candidate.
Demand for Applied Materials products is driven by demand for semiconductors. Demand for semiconductors is being driven by major technology trends. The big ones I've highlighted here: artificial intelligence, rising AI demand for chips needed for training and inference models. This is going to drive demand for cutting-edge manufacturing tools and their suppliers like Applied Materials. Data centers and cloud computing. These are being scaled up at enormous rates. In fact, there's a data center boom underway, particularly in the United States. And as a short side note, please see my previous presentation on LandBridge if you're interested in another company that's going to benefit from a data center build-up.
Yes, and I made a video about LandBridge reacting to his video. So if you want to get more exposure to the data center industry, you can watch my video too. But he's doing great work, and it's unbelievable that it's completely for free. These are some great work, great videos here.
5G rollout. This is going to require more powerful and energy-efficient chips to process increasing amounts of data. The automotive sector is seeing a surge in chip demand as cars increasingly resemble computers on wheels.
Yep.
And consumer electronics are constantly adapting and getting more powerful, driving demand for new and better chips. Data and data processing, or compute, is the theme that ties these trends together. As data processing requirements expand, as the demand for compute power grows, so too does the demand for semiconductors and, by extension, the tools needed to make them. And one critical thing not on this page, data and data processing are expanding exponentially, not linearly. Identifying winners in an industry with this kind of growth dynamic can be very lucrative indeed for investors. These trends suggest Applied Materials business is poised for solid growth in the decades ahead, and likely longer. And the company has a long history of strong performance with solid revenue, growth, EBIT margins, and high returns on invested capital. Over the last 10 years, revenues have compounded at roughly 12% per year on average, from $9.6 billion to over $27 billion. In their latest quarter, they did over $7.2 billion in sales, which is almost as much as their entire annual sales in 2015. While their revenues have grown, so too have their operating margins. EBIT margins have averaged 30% since 2020. This is a substantial level for a B2B manufacturing business. If you were to look at other US-based manufacturing companies, not many would have margins at this level.
Yeah, crazy margins.
But manufacturing businesses are capital heavy. They require a lot of new investment to stay relevant. Applied Materials is no different. It's just that they have a phenomenal track record for generating returns on their invested capital. Their average ROIC since 2020 has been a staggering 43%, and the trend is favorable. They have more than doubled their ROIC rate over the last decade. Strong revenues, margins, and ROIC have resulted in significant growth in free cash flows, the ultimate arbiter of value for shareholders. This has grown from $691 million in 2015 to over $5.7 billion by the end of 2024. In other words, their free cash flows have compounded on average at 27% for the last 10 years. For shareholders, this has meant sizable share repurchases. On average, the company has bought back 3.5% of the total outstanding shares per year for the last 7 years. And although their dividend yield seems small at roughly 1%, when you combine this with the share repurchases, the yield is roughly 4.5% per year. And that's before...
Exactly. Even if the earnings remain stable for the future years, the company is a buyback machine and a dividend machine. So you will not lose a lot of money if you invest in this one. This is why I love this risk reward so much. Even if the semiconductor industry is stable or collapsing for some years, like a big crash in the semiconductor equipment industry, it is fine. The business is fine. They don't have a debt problem. They can do massive buybacks and massive dividends.
Or you consider that the dividend has compounded at 14% per year over the last decade. Altogether, not a bad profile for returns of shareholder capital. However, a key question emerges, which is, how much is the company trading for? Can you buy it at an attractive price? It can be argued that a company like this can always grow into its valuation if it seems expensive, but in this case, investors should watch for the cycles. Semiconductor demand is cyclical. It can take years for new production facilities or fabs to be built. As it comes online, new capacity increases chip supplies and drives down pricing until demand catches up and requires new capacity to be added. The cycles are typically multi-year processes. And Applied Materials stock has historically traded in a cyclical fashion. Just looking at the stock over the last decade, there have been 3 major cycles. The first starting in 2015, when Applied hit a new all-time high of $24 per share. What followed was a rapid 40% drop in 6 months. The stock moved sideways for a few months and eventually recovered to its $24 level 8 months after hitting its low. From there, the company experienced a growth phase until 2018, when they hit another all-time high of roughly $62 per share, followed once again by a sharp 48% drop over the next 7 months.
It's massive.
Again, the stock moved sideways for a bit, but recovered to its previous highs about 13 months after hitting its low. Another growth phase for the next couple of years until 2022, where it hit another high of $167 per share. This time, a sharp drop of 55% over 10 months, followed by a 13-month rebound to its previous highs and another growth phase. So now the question for investors is whether this pattern is repeating once more. The company hit its latest high of $256 per share and has dropped to $156 per share, or roughly 40% over the last 7 months. If this historical pattern holds, the stock can drop further, but it could be approaching a bottom.
Okay, so now it will be pretty interesting. So you have a new high of $256 that was hit here in July 2024, and since then, look at this, the stock is down minus 46%. I'm recording this video after Trump announced something, so the stock rebounded a lot. But yeah, I mean, if you look at the total lows, maybe we reached minus 50% this week, like at the beginning of the week. I'm recording this video right now. So yeah, this is a drawdown. The company is cut in half now.
Prudent investors will know it's impossible to time the market, but I would suggest that this could be an excellent time to consider dollar cost averaging it.
Yeah.
It's a volatile stock, but as we've seen, investors are getting 4.5% via dividends and buybacks to ride out this volatility. And historically, the time to buy Applied Materials has been after one of their large pullbacks. There are, however, some risks. Emerging geopolitical risks in semiconductor supply chains could change the historical narrative. Semiconductors have been in the news a lot recently and are a sensitive geopolitical matter. China has been a significant market for Applied Materials, accounting for over 30% of sales in some previous years.
Yeah, like if you check the competitors, all the competitors have some exposure to China, roughly 30-40%. If you look at Lam Research, if you look at the KLA Corp, they all have the same trend.
It's down from those levels, but still quite material. Tariffs, trade restrictions, etc. These are new developments that were not present during previous market cycles. But, and this is important, global demand for semiconductors will not change significantly. The demand is driven by demand for data processing, compute power, etc. And so while the China risk from trade barriers might hurt Applied Materials in the short term, in the longer term, it's just going to shift their customer base to other regions. For the purposes of my valuation of the company, I simply ignore the risk from the final value. However, I do include it in the timeline to reach this value. I think the share price recovery from the bottom of the cycle may take longer. Interestingly, another risk came up just as I was finishing this presentation. This is an article from Nikkei Asia published yesterday, and it was highlighting China's push for self-sufficiency in semiconductor manufacturing. While news in previous years has focused primarily on leading-edge chips, so think top-of-the-line production technologies, those are the ones that have faced trade restrictions. There have been other developments in lagging-edge production. Think chips required for everyday devices, for appliances, automotive, and so on. The things that don't need state-of-the-art compute power. China has put substantial government investments into this sector, and where the government invests, market distortions soon follow. We are now seeing overcapacity and price wars emerging in China for these chips, and this could well spread globally as Chinese companies dump their chips into global markets. As they are subsidized by the Chinese state, the usual profit-loss mechanisms may not work as effectively since the Chinese firms may be able to comfortably sell at a loss in the name of gaining market share on behalf of China. Interestingly, the Chinese government has also focused on developing the tools for making these chips domestically as well. Progress has been slow in this dimension given how complex these tools are, but in some cases, they seem to have managed to replace some of Applied Materials equipment in production, or that threat is on the horizon. Again, the machines they have developed domestically are not nearly as efficient, but I think those domestic companies may not care as they're subsidized heavily by the Chinese state, and their main goal is self-sufficiency, not market efficiency.
Yeah, I've read a couple of news like this in the past, and it turned out that they failed. Maybe you are more familiar with ASML, and there have been rumors that the Chinese government wanted to find an alternative solution to ASML, EUV solution based in China. For the moment, that's just rumors, and it's not the first time somebody tries to copy these companies. And these companies have a moat, so it's very difficult to create the same architecture, and also to operate these big tools, these big devices, this big machinery. So they have the idea, but for the moment China is lagging behind by a lot. So it is coming fast, but not fast enough. For the moment, they are just rumors, not real facts.
This is a relatively new development that is different from prior cycles that involve overcapacity and price reductions until demand once again outstrips supply and triggers the next wave of capacity building. In this case, the usual market signals may be absent, and this is something worth watching closely. Again, I've not considered this in my overall price target, as I think the global demand growth will remain high over the longer term. I have, however, extended the timeline I think it could take Applied Materials stock to recover from its current downturn. For long-term investors, this should not be concerning, as it would mean a longer period to accumulate shares at an attractive price. Also keep in mind that 4.5% yield from buybacks and dividends is not going anywhere. In fact, it's likely to go higher if the price remains depressed. Finally, this brings me to how much the company is actually worth. And for this, I make some basic assumptions and forecast out for 10 years. I take a weighted average cost of capital of 13% based on an industry average. Revenue growth of 12 to 13% is my base case, which is in line with the previous decade, and potentially an underestimate given the scale of the global demand drivers ahead. I run scenarios around this case from low growth scenarios of 8% to higher growth scenarios of 15% so that you can get a comparison. I take a very conservative assumption on EBIT margins. EBIT margins have averaged about 30% for the last 4 years. I assume a 26% EBIT margin in my model. If they continue to have higher EBIT margins or just maintain today's levels, then my valuation should be adjusted significantly higher. Perpetual growth rates of 3 to 3.5%, as this is a sector that will show solid growth for decades to come, and the demand for compute is going much higher. Depreciation and amortization, although not the biggest contributor to this valuation, it's layered in taking into account existing CapEx trends, and a 10-year depreciation schedule. Tax rates and net working capital changes are forecast based on historical averages. And with these inputs, and again, I would stress it's a pretty conservative estimate given those low EBIT margin assumptions.
For sure.
With those inputs, I would value Applied Materials at $293 to $330 per share over the medium term. Considering the historical trading cycles, adjusting for the new China risks, and today's share price of $156 per share, that's an implied upside of 90% to 110% in the next 24 to 36 months.
Yeah, and now the stock is even cheaper, $138. So it's more than a double.
Again, how conservative the EBIT margin estimate was in calculating that figure.
So he takes conservative figures for the EBIT margin. He takes a normal forecast for the revenue growth. And for the perpetual growth rate, maybe it's at a little bit too bullish for my taste. So maybe you can reduce this a little bit, increase this a little bit, but you can get roughly the same. The long story short is the price is $140 and the stock is worth at least double than that current price is. So yeah, maybe that's an easy double when the cycle turns.
Also, shareholders are getting, while they wait, 4.5% via dividends and buybacks to ride out any volatility. Altogether, a very attractive story. In summary, Applied Materials should be nearing the bottom of their latest cycle, representing substantial upside potential for patient value investors who can stomach some volatility. Investors would be buying an ownership stake in one of the largest, most diversified semiconductor manufacturing equipment suppliers in the world, with an installed base of roughly 40% of total semiconductor tools by tool count. There are enormous technology trends driving the secular long-term growth in this sector. Think artificial intelligence, machine learning, data centers, cloud computing, 5G connectivity, autonomous driving, electric vehicles, consumer electronics, etc. As the world needs to process more and more data, it needs more and more compute power and needs more and more of what Applied Materials provides. The company has shown incredible long-term performance. Revenue compounding on average 12% per year, EBIT margins over 30%, and returns on invested capital over 43% in 2024. Free cash flows compounding on average per year at 27% for the last 10 years. High returns of capital to shareholders are an additional feature. First, via buybacks that have averaged 3.5% of the total outstanding shares per year for the last 7 years. And second, with dividends currently yielding roughly 1%. This equates to around 4.5% to shareholders, which is pretty attractive for a company like this. And as a bonus, the dividend has grown on average at a compounding rate of 14% for the last decade. The stock has traded cyclically over the years, with 3 major cycles in the last decade. Based on historical patterns, Applied Materials seems to be nearing the bottom of a 4th cycle. This represents a potentially lucrative time to buy. There are some risks, particularly new China risks associated with geopolitics and production overcapacity. While these will impact the company and industry short term, I think they're unlikely to shift the major technology trends long term. I think they will potentially expand the bottom of the cycle, but even with that, the shares are attractive at today's levels. And a quick warning though, timing the market is impossible, so dollar cost averaging into this one is probably the best way to go. I put a medium-term price target of $293 to $330 per share, which is a very large upside potential from today's $156 per share. I think it'll reach these levels in the next 24 to 36 months. For value investors with of the global demand drivers, 10% of the total outstanding cycles in the last decade. No politics, but even with that, the shares are attractive at today's levels. And a quick warning though, timing the market is impossible, so dollar cost averaging into this one is probably the best way to go. I put a medium-term price target of $293 to $330 per share, which is a very large upside potential from today's $156 per share. I think it'll reach these levels in the next 24 to 36 months. For value investors with patience and an ability to handle volatility in the short term, I think Applied Materials is worth the risk. And with that, a very big thank you for listening. The presentation document will be uploaded shortly to the McNamara brief.
Okay, so yeah, and now the stock has dropped a little bit further, so it has even more upside. If you think that the stock will continue its cyclicality, if you think that you are a value investor, if you think you are patient, maybe this is a good opportunity for you. I will update you guys. Maybe I will buy it. I see the opportunity. I've been following the stock since 2020, so it's been 5 years now. And I went through 2022 and I heard some bad things, bad reports, and it turns out that it's just the way the stock is done. You have cyclicality in this sector, nothing to worry much about. And I think we have the same opportunity here. But nobody knows. Maybe they will have stronger problems, but for the moment, I see the thesis as really intact. Again, thank you. You can subscribe to the McNamara brief. Amazing analysis from Stephen McNamara. Congrats, that's amazing. You can check his website. And that's it for today, guys. I think you have a pretty good overview of what Applied Material is, and I think you can see the opportunity that I'm seeing at the moment. So yeah, always happy to read your comments below about the thesis if some of you guys own the stock. And that's it for today's, guys. I hope you learned something, and I wish you a nice rest of your day. Goodbye.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.